Welcome back to ETF.com Live. My name is Dave Nottig, Managing Director at ETF.com. Had a great question from today's ETF Live chat asking about bonds versus bond ETFs. It's a question we get a lot, and really it comes down to one core issue. Which one's the right choice for you? And there really are differences. When you buy an individual bond, you're generally going to hold that bond from now until it matures. So if you buy a 20-year treasury, that 20-year treasury becomes a 19-year treasury next year and an 18-year treasury the year after that, until eventually the government just sends you back a check. The same's true if you bought, say, a Citibank bond, right? You're going to hold that for however much time is left between now and when that bond matures, and you'll get your money back. Along the way, you're going to collect coupon payments. And that's really the reason people buy bonds in the first place. They want to get that income stream off of an initial investment. So for years, advisors and investors have bought those individual bonds. And if they wanted some sort of continuous exposure, they'd ladder them. They'd buy one bond that's next year, one bond that's the year after, one that's the year after that. And overall, you might have 20 bonds that on average give you about a 10-year duration. But you collect that income over time, and as one comes due, you use that money to buy a little bit further out. A bond fund generally does something pretty different. If you buy a 20-year treasury bond ETF, it's always going to try to have that target maturity of 20 years. And that means over time, it's going to have to sell bonds that are now 19 years old, and you're going to have to buy bonds that are just being put up for auction. That means that you're going to have buying and selling. And in that process, you're going to see and experience changes in the value of those bonds. So you'll see that value of your bond fund go up and down. The value of the individual bond you might own, you're probably not going to pay attention to because you know in the end you're going to get your money back. So for most folks, bond funds give you a couple of advantages. They let you manage that duration and maturity much more carefully. You don't have to worry about picking and buying and selecting those bonds. You don't have to manage a bond ladder, etc. And you'll still get that regular income, but you'll be exposed and experience that up and down in the price of the bonds a little bit more directly. So it's that convenience factor that leads most people to invest in a bond fund of some sort, whether it's an ETF or a mutual fund. There's one last thing that bond funds are going to get you that you're not going to get by trying to do this on your own, and that's diversification. Now, diversification doesn't really matter much if you're just buying treasuries, but if you're buying corporate bonds or if you're buying junk bonds, diversification can really matter because you don't want to be holding a bond that defaults as your only investment in the corporate bond space. You literally lose all your money when a corporate bond defaults. By investing in a bond fund that owns maybe 100, 200, 300 corporate bonds, now you're much more likely to have a positive experience even if one or two of those bonds defaults over the course of the years in which you own it. That's it for me today. I hope you come back and join us for another episode of ETF.com Live.